first half of 2018, equity markets experienced positive returns, however, at the highest level of market volatility in more than 2.5 years. With rising interest rates, bonds fell between 1% and 4%. Will market volatility continue? And how should investors position themselves to take advantage of market opportunities ahead? We spoke with Citi strategists on the market outlook for 2018. Gene, recently there's been questions on the potential of a slowdown in global economic growth. What's Citi's view on the global economy ahead?
We think the recent moderation in growth is unlikely to signal a start to a major slowdown. For global GDP, we still estimate it to grow at 3.4% in 2018 and 2019. In the US, growth is expected to accelerate to 2.9% in 2018, driven by stimulus from tax reforms as well as increased fiscal spend. In China, we expect the government to continue to focus on economic policies reform, but still maintain growth rate of 6.7% for 2018. However, trade tensions should be monitored closely, as any worsening in global trade relations could pose a major restraint to global growth outlook.
Given equity investors experienced volatility in the first half of 2018, are there still opportunities ahead?
We think market returns will be more modest in 2018, but selective opportunities remain. Emerging markets, in particular Asian equities, is expected to benefit from strong economic growth and earnings growth outlook. And more importantly, valuations is attractive. We expect Eurozone recovery to continue, and with strong, healthy corporate balance sheets, dividends will rise. This will help to provide some buffer to investors should market volatility rises on the back of political risk in Italy. In terms of sectors, Citi believes another year of decent economic growth should continue to favor cyclicals over defensives. We like energy, materials, technology, and financials.
Umar, with 10-year U.S. Treasuries at 3%, their highest level since 2014, some investors are raising questions about the potential of inflation. What's Citi's view on inflationary pressures in the year ahead?
Well, a recent solid monthly inflation data suggests that the Fed's 2% inflation target is within range. Having said that, we still expect the Fed to maintain a gradualist approach, and with yields at 3% on the 10-year, we think a large part of the Fed's tightening path is priced in.
Given the rising interest rates, what are some of the bond opportunities that investors should consider?
Well, with higher relative yields and a still positive fundamental backdrop for emerging market economies, as well as the US dollar, which is expected to revert to a weakening trend, we think actually the fundamentals and the valuation backdrop for emerging market bonds is still quite supportive. We also like US investment grade, which has seen spreads widen, and we like US high yield, supported by a solid macroeconomic backdrop, a declining net supply, and still low default rates.
Jai, the US dollar had a surprise rebound in April. Is this trend likely to continue? And what's Citi's view on the G10 currencies?
Yes, the dollar gains have been largely due to two transitory factors. One, the delayed global policy convergence theme because of the unexpected slowdown in Eurozone and other parts of the globe. And second, the unusually large call on dollar liquidity by the US Treasury auctions that have expanded since President Trump announced his fiscal stimulus. We expect both these factors to fade and for the markets to revert back to the structural dollar weakness theme of worsening twin deficits. The beneficiary is going to be the euro. It has been oversold with the Italian crisis adding to the negative tone of late. But as the markets start to focus back on the improving European fundamentals, we expect investors to revert back into the euro.
And what's the outlook for Asian currencies?
We expect the Korean won and the Thai baht to outperform, given their strong current account surpluses amid thawing Korean tensions. On the dollar CNY, we expect a range-bound unit. But we will keep a close eye on these trade tensions if they escalate further and whether the Chinese are tempted to use their currency as a policy tool in negotiations. On the commodity currencies, stronger fundamentals of late are supportive of these currencies at these cheaper levels, but there's no real tendency for these currencies to rally sharply once the dollar starts to weaken.
We hope you found these insights helpful. For more information, please speak with your Citigold relationship manager.